Well, thanks so much for tuning in to this earnings conversation with the management of HCL Technologies. Their constant currency revenue growth 2.7%, otherwise of 3.8% QOQ. Can't find too many faults with the revenue numbers. The street is a bit disappointed with the margin performance, as has been the case with its peer that came out late last week as well. The interesting thing would be that their FY23 guidance remains unchanged at 12 to 14% constant currency revenue growth, and EBIT margin range in the range of 18 to 20%. The questions to the management, I'll play the devil's advocate here, is that I'll lay out all the risks and ask them to respond to each of them one by one over the next 10 minutes that we talk to them. Vijayakumar and Prateek Aggarwal join me. Gentlemen, thanks so much for joining in. I hope all is well. CVK, you wouldn't find too many faults with the revenue growth numbers. The street might be a bit circumspect for the space at large about whether these numbers can continue to the next 8 quarters, considering that the US seems to be heading towards the recession way. What are your thoughts?
Yeah, Neeraj, as I pointed out in our conference call as well, our pipeline continues to be at an all-time high. So we continue to remain positive about the overall demand environment. And the demand environment has 2 broad segments. One is driven around transformation and a lot of new initiatives to drive better business outcomes, which also eventually results in a lower operating cost. But there are also managed services, integrated operations, cloud migration. Some of that is also driving costs down. So customers are looking at large deals, which will help them to kind of optimize their costs. So I think given these 2 dimensions, I feel quite positive about the demand environment. And you would have noted that we crossed $3 billion quarterly revenue, which is at $12 billion annual run rate. It's been an impressive growth over the last many years. Our engineering services crossed $500 million a quarter. Now with $2 billion run rate, we continue to be the largest engineering and R&D service provider. So there are a lot of good milestones and good growth, good booking. Bookings went up 24%. Of course, margins were lower than even what we expected, which is in line with the industry challenges that everybody is facing. And there are good operating levers, which we believe will kick in as we focus on this element of the business.
Yeah, I'll speak to both of you about that. But just a quick follow-up, CVK, and a slightly macro question before I get back down to the micro. For a number of quarters now, skeptics keep on talking about whether or not the IT services growth has many reasons to slow down. And there are various reasons pointed out. The slight difference this time around, you could argue, or one could argue, is that the US economy may not be in a really good shape, maybe, say, 3-4 quarters down the line. So where are you on this argument? Do you reckon that that could have an impact? Or do you reckon that because it might be in a slowdown or a recessionary mode, businesses might be forced to cut costs more, and therefore resorting to increase offshoring might be a way, which means that Indian IT services companies, large ones at that, will not get impacted too badly?
Yeah, Neeraj, I've always taken this view. While macros are very important guiding post for various dynamics that play out in the business, but it's all about focusing on the right opportunities to get to where you want to get to. Right, the market is very big. Right, it's not a IT services market is a $1 trillion kind of a market, and there are always opportunities for the right type of service providers, and we just need to look deeply and narrow down on those opportunities which are really going to make a difference, and put all your energy behind it. And we've always done this very well, irrespective of an upcycle or a down cycle. It's just how do you prioritize and focus on the right set of deals and clients to get to a good growth number.
Okay, we'll talk about segments in a moment. Prateek, can I draw you in on this conversation and start off with what seemed to be the bugbear in all the brokerage notes that I read? Now, you had guided in the last quarterly conversation with me that you will see, people will see some bit of a margin drawdown in Q1 because of various factors. It's lower than the guided range as well. You believe as CVK said, there are enough levers to pull it up, and could it happen starting Q2, or even that quarter might see a bit of a wage hike impact?
Yeah, Neeraj. Yes, the margins has been the most commented about, and clearly we are sticking to the guidance that we provided last quarter, albeit towards the lower end of that range, because obviously the starting point itself, we are about 1% lower than the margin band. So what that definitely tells you is that we are looking to increase the margins pretty much every quarter in the rest of the 3 quarters to be able to get within that lower end of that guided range. Typically, you will remember, Neeraj, that Q3, because of the P&P seasonality, tends to be our best quarter in terms of margins. That is what we would certainly aim towards that. Q2 will be obviously somewhere in between. We'll have to see where we exactly land up. We don't want to get into a quarterly guidance
Sure.
kind of a mechanism, but there are enough and more levers that we have to draw upon and improve the margins from where we are at the end of Q1. Chief amongst them being the bill rate improvements, the absorption and deployment of freshers, and the pyramid optimization that happens due to that. The third being the optimization of the outsourcing and subcontractor costs, and then of course offshoring and automation and all the typical levers that we have will be leveraged to deliver.
Got it. Okay, so the billboard will be Q3, Prateek, but you'll start seeing some improvement Q2 onwards. A bit on Prateek on attrition versus fresher hiring, and how is that shaping up? Because in Jan, I think you and a lot of other industry heads did say that it's a bit difficult to point out when will this supply side issues challenge get over. It might persist for a while. A bit on that, Prateek.
Yeah. So unfortunately, that supply side pressure continues unabated, and in a certain way, it's probably a reflection of the good demand side that we continue to see, and therefore it is kind of difficult to predict when it will come down or get easier, because it's kind of linked, right? And this quarter and the next quarter continue to be elevated, and therefore the LTM last 12-month attrition that we publish would potentially go up even further compared to where we are. We are at 23.8% on a LTM basis this quarter. So that continues to be a challenge, and it's kind of structural. I think as an industry, we need to do something about it, but we'll have to do what we can on a individual company basis.
During an investor day, CVK, I think May 11th, if I'm not wrong, you said that you were confident of reporting better organic growth versus peers. We were also trying to get a sense of how would some of the individual segments might have done for you this quarter, and how do you expect them to shape up, particularly the product platforms. Can you throw some light here?
Absolutely. If you look at our growth this quarter, services growth, it grew 19% year on year. A very large part, maybe 18.5%, is all organic. We've hardly done any acquisitions. Some small revenue would have come in this quarter on acquisitions. So our organic growth momentum is solid, right? The previous 3 quarters of 5% plus sequential growth, 2.7 now, very strong growth in engineering services. Engineering services has consistently delivered 4% plus kind of sequential growth, and we continue to see that momentum there. IT and business services is driven by our digital business, or the application services, consulting and analytics and data insights. That business continues to grow very, very fast. Infrastructure growth is slightly lower than the other service lines, because infrastructure has this productivity levers, and which based on a lot of new deals rather than incremental client mining. So all of that is going very well. We've acquired some marquee logos. We won 16 large deals, 8 of them in services and 8 of them in products, adding up to 2 billion plus, which is a 23% growth. So all along, we are very bullish on the services growth and growing services in a capital efficient manner so that we can improve our return on the invested capital. And overall, one of the objectives that I stated is to deliver the top quartile TSR. And you might have already been tracking the LTM June. HCL delivered the highest total shareholder return among our peer group of companies. So we are pretty well glued on to our strategic objectives.
Yeah, indeed, some of the micros are working out very well. So we can, I presume, the seasonality around the products and platforms in Q4 would also have gotten taken care of. So since I have just 1 more minute, I'm not getting into that. I just wanted a broader perspective, CK. At the start, we talking at the start of the year, so to say, end of Q1, 3 more quarters to go. And I might sound like a broken record, but I'm just trying to understand a lot. So the common, the bull argument on what the space could do over the course of the next 2, 3, 4 years is that don't focus too much on what assumptions might be. Focus on what clients are saying. And thus far, every company worth its salt is saying client conversations are not indicating any slowdown. If anything, while they might not be indicating price increases conversations as yet, that might also happen very soon. Can you leave us with some flavor here, CVK, because you're so close, because you reside in that area? How are things happening there?
So Neeraj, I do believe the industry is still very buoyant with demand and it is supply constrained. So the supply demand constraint is what is probably limiting the growth rather than really not having demand. And that has been the situation over the last 5-6 quarters. So even if demand moderates a little bit, it will still at best match supply demand rather than really kind of being a derailer. That's how I would classify the current environment.
Okay, so just before we leave you, CVK and Prateek, CVK, just so the fears, I mean, would you say that as of now, these are at best fears and don't reflect the reality, that the fears around how companies like you as well, for example, might not miss revenue growth this year, but next year it could be a challenge? For some of your peer sets, it's been spoken about that they might go into single digits as well. Now, my question is, do you believe that's a fear at best, or is there some evidence of that based on conversations or otherwise?
There are. I mean, I think it's what's happening in the economic environment is well known. There are some pockets where there is some moderation, but all what I'm saying is there is enough demand. If you can refocus your the opportunity addressing mechanisms to refocus on the right kind of clients and segments, I think you can continue to grow very well.
Well, it'll be a treat to see you guys do that and exhibit that in the quarters to come. CVK, Prateek, thank you so much, gentlemen, for taking the time out and speaking to us today.
Thank you.
Thank you, Neeraj.
And viewers, thanks for tuning in.